Welcome to Talk Takers. We're your regular deep dive into earnings call summaries. Today, we're digging into Marvell Technology. Their Q2 fiscal 26 numbers just dropped, and we're going to sift through all the details, pull out what really matters for you. So let's kick off with the big picture. Marvell posted record revenue, really strong year-over-year growth, and it seems like it was mostly fueled by what they keep calling massive AI demand. Sounds pretty good, doesn't it?
It does sound good. And, the Q2 results themselves, they basically met expectations. Pretty solid performance overall. But the kicker was the Q3 guidance, that forward look. It definitely put a dent in investor sentiment. We saw that reflected in the market reaction right after the call.
Yeah, that after-hours drop was noticeable. Yeah.
It's that classic tension, right? Strong current results versus maybe a slightly less certain next step.
Okay, let's get into those Q2 numbers then. What actually stood out? Well, record revenue, like we said, $2.006 billion. That's up 6% from Q1. And get this, 58% higher than the same quarter last year. Pretty significant.
58% is huge growth year on year.
Right. But here's maybe the even bigger headline. Their non-GAAP EPS, the adjusted earnings per share. Also a record, $0.67. That was right on the money with what analysts expected. But it represents, an incredible 123% jump compared to last year.
Wow. Okay. 123% EPS growth. That's more than double the rate of their revenue growth. That tells you a lot about operating leverage. They're getting much, much better at turning sales into actual profit.
Exactly. That efficiency story really comes through.
Super important when you're scaling up fast, especially in these high demand areas.
And you see it in the margins too. Non-GAAP operating margin hit 34.8%. That's up 870 basis points year over year. So nearly 9 percentage points higher.
Yeah, that points to some serious operational improvements. Execution is getting tighter.
Definitely. And cash flow looks strong too. $462 million generated from operations. That's way up from $333 million in Q1. Gives them a lot of financial breathing room.
And that financial muscle, that's key, right? Allows them to make moves. Buying back $200 million in stock just in Q2, that's over $500 million in the first half of the year.
Right. And they still have $2 billion left on that buyback authorization.
Plus, they did that $1 billion notes offering. Smart move, using most of it to pay down older debt. It's not just returning cash, it's also, cleaning up the balance sheet to support future growth. Smart capital management.
Okay, now let's pivot to the engine behind all this, the data center segment. This thing was absolutely the main growth driver. Accounted for, 74% of total revenue?
74%, yeah, just massive.
Came in at $1.491 billion. That's up 69% year over year and about 3% sequentially.
And what's driving that?
Well, according to them, it's mainly two things. Custom AI silicon, so specialized chips for AI, and their electro-optics interconnect products, the high-speed links.
And within data center, AI and cloud are over 90% of that revenue.
Over 90%, yeah.
So data center isn't just a growth area. It's basically becoming Marvell itself. The whole company narrative is shifting. It's all about AI and cloud now. That's their identity.
It really seems that way.
Well,
but it wasn't just data center showing life. Other segments showed some recovery too. Enterprise networking, $194 million, up 28% year over year.
Okay.
And carrier infrastructure hit $130 million. That was up a really strong 71% year over year.
71%.
Yeah.
Nice bounce back there.
Yeah. If you combine those two, they grew 43% year over year, 2% sequentially. They're talking about an implied run rate of $1.7 billion a year now.
Yeah.
For those combined.
Which is a solid recovery from that low point. Wasn't it $900 million back in Q1 of fiscal 25?
Exactly. So that suggests customer inventory issues are clearing up and maybe their newer products are gaining traction.
Right. And while AI gets all the attention, having that enterprise and carry business recovering, it provides a more stable base. It shows they aren't totally reliant on those big, sometimes lumpy, hyperscaler projects. Diversification helps, even within tech.
Good point. And even the consumer segment saw a nice jump. $116 million, up 84% sequentially, 30% year over year. Mostly gaming demand, they said, and just seasonality.
Okay.
Automotive and industrial came in at $76 million, pretty much flat quarter over quarter and year over year. But that segment is about to change quite a bit, isn't it?
That leads us right into the strategic stuff.
Yeah, this is where it gets really interesting, I think, for their long-term direction. They closed the sale of their automotive Ethernet business, sold it to Infineon, $2.5 billion, all cash.
And ahead of schedule, too. They were initially targeting year-end for that.
Right. And management was super clear about why. They said it directly aligns with focusing on the massive AI opportunity. They're deliberately shifting investment away from other areas towards the data center.
Makes sense. Post-sale, that auto industrial segment is expected to be much smaller, maybe $35 million in Q3 revenue.
Yeah, a big change.
Yeah. Look, this divestiture, it's more than just getting cash. It's a strategic declaration. They're basically shouting from the rooftops, we are an AI company now. Streamlining the portfolio, focusing the message.
And that focus carries over into how they'll report revenue from now on. Starting with Q4 results, they're simplifying things. Just two categories.
Two categories?
Yep, data center, obviously, and then a new bucket called communications and other.
Okay, so what goes in communications and other?
That'll lump together enterprise networking, carrier infrastructure, consumer, and what's left of industrial.
Ah, okay. The logic being data center is now 3/4 of the business.
Exactly. While those other four combined are only about 26%. Makes the reporting cleaner, reflects reality.
Yeah, it absolutely clarifies the investment story. If you're investing in Marvell, you're primarily investing in their data center and AI play. Simple as that.
And they've adjusted leadership roles to match this focus. Chris Koopmans is now president and COO. He's overseeing sales, the non-data center businesses, corporate development, basically everything outside the core AI engine.
Got it. And then for the main engine.
Sandeep Prathi got promoted to president of the data center group. He's got the whole thing end to end. Tech, customers, the works.
Aligning the org chart with the strategy makes perfect sense.
Okay, so strategy aside, let's talk tech, what's actually driving this and what's coming down the pipe. On the custom AI silicon front, remember that investor event back in June?
Mm-hmm. They raised their TAM forecast, right?
Yeah, significantly. They now see a $94 billion total addressable market for data centers in calendar 2028. That's up 26% from what they thought before. And they introduced this new category, XPU attach.
XPU attach, connecting specialized processing units.
Basically, yeah. And they updated their scorecard. They now have 18 custom chip design wins secured, multi-generational deals.
18 sockets. That's a lot of specific long-term engagements.
And they're talking about over 50 new opportunities in the pipeline, potential lifetime revenue, $75 billion.
$75 billion. That's a massive pipeline. But, the key question is always, how much of that potential turns into actual recurring revenue?
True. But they did say several custom programs are already in volume production, ramping up now.
Okay.
And more are expected to ramp over the next, say, 18 to 24 months. Plus, since June, they've apparently won more deals with multi-billion-dollar potential.
So the momentum on custom silicon wins seems to be continuing.
Seems like it. And they're pushing the tech boundaries, too. Announced industry-first 2-nanometer custom SRAM.
2-nanometer SRAM. That's critical for speed in AI chips, right? Super fast on-chip memory.
Exactly. And also this 64 gigabits per second per wire, bidirectional die-to-die IP.
Whoa, okay. That's about getting data between chips, like chiplets, incredibly fast, very important for complex AI systems.
Right, so it's not just winning deals, it's winning with some pretty advanced technology.
That technological edge is crucial. It's what differentiates them.
Then there's the electro-optics side. The interconnects, they've started shipping their next-gen 1.6 terabit PAM4 DSPs. That's for 200 gig per lane optics.
1.6T, that's the bleeding edge for data center speeds right now.
Yeah, the demand for the current 800 gig stuff is apparently still strong, too.
Makes sense. These transitions take time.
And they're already looking ahead.
Yeah.
They demoed technology for 3.2 terabit optical links using 400 gig per lane.
Always pushing that speed envelope. And they mentioned the Microsoft collaboration, too.
Yep. Expanded work with Azure on their liquid security hardware security modules.
Yeah.
Shows those deep hyperscaler relationships.
It really paints a picture of a comprehensive offering, doesn't it? Custom chips, high-speed optics, interconnect IP, security. They're hitting multiple layers of the AI stack.
Making themselves pretty indispensable, you could argue.
Seems like the strategy.
And it also extends into networking within the AI cluster, what they call scale-up networking. They're developing switches designed for specific customer needs, supporting both standard Ethernet and things like UEL link.
UEL link, that universal access layer interconnect.
Right. And their portfolio covers everything. DSPs for active cables, retimers for PCIe and Ethernet, silicon photonics for co-packaged optics.
Covering all the bases for how you connect things inside these massive AI pods.
Yeah. They expect new product intros for UAL link and Ethernet scale-up within the next couple of years.
So a lot of irons in the fire. Strong current performance, strategic refocusing, deep tech pipeline.
Which brings us back to that guidance, right? If everything's so strong, why the slight miss on Q3 revenue outlook.
Ah, yes. The source of the market's immediate heartburn.
So the actual guidance, Q3 revenue expected at $2.060 billion, plus or minus 5%. That midpoint, it is a little below what the street was looking for, around $2.11 billion.
Just slightly below consensus, but enough to raise eyebrows in this market.
Interestingly, though, the EPS guidance was actually above consensus, 74 cents plus or minus 5 cents versus maybe 72 expected.
Okay, so revenue slightly light, but profitability holding up or even beating expectations. Continues that operating leverage story.
It does, but the market focused on the revenue, specifically the data center piece. They expect data center revenue to be basically flat sequentially in Q3.
Flat, after all that growth.
Well, the explanation is that electro-optics is expected to keep growing strongly, maybe double digits sequentially. But that strength will be offset by lower revenue from the custom silicon side in Q3.
Ah, the custom business. That's where the lumpiness comes in.
Exactly what they called it, lumpiness. They said it's normal for these huge hyperscaler projects, especially as new programs ramp up. It's more about the timing of deliveries and customer build schedules, not some underlying demand weakness.
Right. These multi-million, sometimes billion-dollar custom chip projects, they don't just flow smoothly quarter after quarter. There are milestones, delivery schedules.
And they did stress that the custom business is still expected to grow in the second half of the fiscal year compared to the first half. And that Q4 should be substantially stronger than Q3 for custom silicon.
Okay, so it's a timing issue within the custom segment, offsetting strength elsewhere in data center for Q3 specifically. That context is important.
Yeah, I think so. What about the other segments for Q3?
Well, enterprise networking and carrier infrastructure combined are expected to jump about 30% sequentially. That recovery looks solid.
30% sequential growth there is pretty strong.
It is. Consumer expected down low single digits, which is probably normal after the Q2 bump. And auto industrial at that new baseline, around $35 million post-divestiture.
And they made a key point about the overall AI contribution. The total AI number, meaning optics plus custom silicon, they expect that to cross 50% of total company revenue before the fiscal year is out.
Crossing 50%? That's a major milestone, reinforces that AI identity shift.
Absolutely. And even with flat overall revenue guidance for Q3, that EPS guidance implies 10% sequential growth at the midpoint.
Still showing that operating leverage, yeah. Growing profits faster than revenue.
Okay, let's put it all together from an investor's viewpoint. The market reaction was pretty swift, wasn't it?
Oh, yeah. The stock dropped, over 11% after hours? Closed around $68.50 after being near $77?
Headlines everywhere flagged downbeat guidance. Shows how sensitive things are right now.
Extremely sensitive. Any hint of deceleration, especially in AI-related names, gets punished, even if the long-term story seems intact. It really highlights that gap between management's confidence in their multi-year plan and the market's demand for, near-perfect near-term execution.
So the overall feeling is kind of cautious constructive. Is that fair?
I think that nails it. Q2 was solid, the AI momentum is undeniable, the strategy seems clear, but that slight Q3 revenue softness, driven by that custom AI lumpiness, just injects a dose of caution.
Investors are watching that custom silicon ramp very, very closely. They want to see smooth, predictable growth if possible.
Even if lumpiness is inherent to the business model, the market doesn't always like it.
Still, management is sticking to their guns on the long term, reiterating that 20% share goal of the $94 billion data center market by 2028.
And pointing to all those design wins in the pipeline as evidence.
So for anyone watching Marvell, the key things to track are probably DC interconnect demand trends.
The pace of those big cloud wins actually turning into revenue.
And just more updates on how those custom AI programs are ramping up quarter by quarter, getting past the lumpiness.
Exactly. Visibility is key.
Right. Now, thinking about that market reaction, that immediate drop feels like a classic case, doesn't it? Short-term jitters versus a potentially strong long-term narrative.
It really is. The market zooms in on that single data point, the Q3 guide, and maybe overlooks the context, the pipeline, the tech wins.
That $75 billion lifetime revenue potential from the pipeline. The market seemed to forget that pretty quickly.
Happens all the time. Recency bias is powerful. For a patient investor, maybe the takeaway isn't the dip itself, but management's confidence despite the dip. It really depends on your time horizon and your tolerance for this kind of quarter-to-quarter noise.
Yeah, and being able to distinguish, like you said, between a real problem and just project timing.
Yeah.
Those tech differentiators, the 200-meter SRAM, the die-to-die IP, those are real advantages that don't just disappear because of one quarter's guidance.
True. The market sometimes paints the whole sector with one brush, but individual company strengths still matter.
Okay, which brings us nicely to our favorite segment. This is not financial advice. Time for an outrageous but plausible trade idea based on everything we've just discussed.
All right, let's hear it.
So, Marvell. Classic situation. Near-term guidance stumble. Market freaks out a bit. Long-term AI story. Looks solid, arguably getting stronger. The market's reaction to lumpiness feels, well, a bit overdone. Like you said, short-term memory.
Okay, so how do you play that?
Here's the idea. A barbell strategy, but with a twist. On one side, we go long. Out of the money Marvell call options. Let's say 6 months out.
Out of the money calls, betting on a rebound, and cheaper now after the drop.
Exactly. Implied volatility probably dipped a bit, making them relatively less expensive. We're betting the market remembers those 50-plus pipeline opportunities, the $75 billion potential, the tech wins.
Right.
Maybe by Q4, when custom AI is expected to bounce back strong.
Okay, that's the long side. What's the short side of the barbell?
Short, a broad semiconductor ETF, like SOXX, the Philly semi-index trackable.
Short the whole sector. What?
The theory is, the market might be over-extrapolating Marvell's specific custom-related Q3 dip to the entire semiconductor space, when in reality, Marvell's issues are partly tied to their specific large custom program timing, and their tech differentiation is unique.
Ah, so you're betting Marvell might rebound faster or stronger than the broader sector if there's general semiconductor weakness, or you capitalize on sector softness while waiting for Marvell's specific story to play out.
Precisely. You get exposure to Marvell's potential upside as those custom programs normalize, while hedging against or even profiting from broader sector jitters that might be unfairly weighing on Marvell right now.
Interesting. It's definitely contrarian. You're betting against the market's immediate reaction and on Marvell's specific strength, decoupling somewhat from the general semiconductor mood. It's not just a bet on Marvell. Like you said, it's a bet on market psychology, on that short memory. So the question for you listening is, do you have the conviction and the stomach for a trade like that?
Always the question. So, okay, let's wrap this up. Quick recap. Marvell delivered a record Q2. Revenue, EPS both strong, driven hard by data center, especially AI. That segment is now what, 3/4 of the company?
Yep. And the strategic moves selling auto Ethernet, changing reporting, just hammer home that intense AI focus.
But the Q3 guidance introduced that lumpiness factor, particularly in custom AI silicon, leading to a flat sequential outlook for data center overall.
Right. That tempered the immediate excitement, caused the stock drop. But management is stressing it's timing, not demand. And they remain confident in the long-term AI growth trajectory, pointing to that huge pipeline and continued design wins.
So that recovery in enterprise and carrier provides a nice stabilizing base underneath the AI story.
Definitely part of the picture.
Okay, so as always, please remember, everything we've discussed here on Talk Tickers is purely for informational purposes. It is absolutely not financial advice. You should always do your own homework. Talk to a qualified financial professional before making any investment decisions.
Please do.
Thanks so much for tuning into this deep dive. We'd love to hear what you think about Marvell's quarter and their big AI bet. Let us know. Until next time.